Welcome back, everyone, to another episode on Living Your Greatness. This is your host, Ben Mumme, and today I am joined by a new guest, and her name is Danielle Park. So for those of you that don't know Danielle Park, she's a portfolio manager, a financial analyst, and a best-selling author of Juggling Dynamite. Danielle co-founded Venable Park Investment Council, where she manages million-dollar portfolios for some of Canada's wealthiest families. Danielle has also dedicated 20 years to educating professionals and investors on financial behaviors. And as well, Danielle is also super passionate about personal growth, where she listens to individuals like Rich Roll and has a huge desire for health and wellness. So without further ado, Danielle, welcome to the show. It's a pleasure to have you with us.
Hey, thank you, Ben.
Yeah, no, pleasure to have you on. So let's kind of get moving here. Danielle and I actually met back this past January through a conference at Jay Martin's conference in Vancouver. And we really hit off backstage in terms of talking about overall health and wellness and obviously her domain of, financial wellness. So to start off today's, conversation, Danielle, for my listeners who don't know who you are, tell us a little bit about yourself. Where did you spend your formative years growing up? And what inspired you to become a portfolio manager, financial analyst, and a best-selling author?
Well, that's a very long and winding road, to be honest. I grew up just north of Barrie in actually a farming village outside of Barrie, Ontario, which is an hour north of Toronto. And my dad was an Irish immigrant who met my mom on a farm and ended up staying. And so, I grew up in the 1970s, and it was, if I look back, it was pretty brutal, as the 70s were. Lots of misery and addiction and mental health problems. And I think, I was just thinking about this not too long ago, because it sounds crazy, but there was 6 kids. By the time I was 12, there was 6 kids in my actual close community that had been killed by cars. So I know that's really random, and you think, what do you mean? You mean like in one accident? No, I mean like every couple of years, someone would be hit by a car on my road, which was this county road. And it's still there. It's 2 lanes. And it was just this really bizarre confluence of events because, no one's been killed there since. It's just a really odd thing when you're growing up that every so often, my cousin was killed and very close family friends, a couple of kids in my school. And it was a small little community, as I say. So I think that there was quite a bit of shock and dysfunction all around me. There was a lot of alcoholism in my family. So really, it's amazing, I think, that things have gone as well as they have. But as I look back, I think maybe what that was adversity training. And the interesting thing about life, Ben, as you probably have figured out, it's often the hard stuff that gives us the strength and insight, if it doesn't kill us, or turn us into dysfunctional human beings. If we can learn to work through trauma and kind of grow through it, it can often give us the most wisdom, the most grounding, the most insight. And I would have to say that I've always had a lifelong interest in how do I get better, stronger, improve, growth. I still have a very big growth mindset, and I don't mean financially in that context. I mean in terms of the human being, in terms of insight, psychological balance, health, all that stuff. So I think because of all that kind of craziness in my childhood, I was constantly looking for ways to find greater peace, greater happiness. And that really, set me on a journey of no one I knew had any money growing up. My family was not poor, but they were not well off. And no one had, for example, gone to university yet. So I was the first kid to go to university. And, my father wanted me to be the first woman prime minister of Canada. No tall order there. Being an Irish immigrant, that's their dream. So I went to law school after I graduated from U of T, and I went through all my training, and I was working in Ottawa at a large law firm, and figured out pretty quickly that I wasn't interested in politics, not a political being. So to my dad's chagrin, I was not interested in going into the political realm, and I practiced as a lawyer for a number of years, and I found that I did a lot of litigation, because I'd had sort of a big theater background through school. I'd done a lot of, performing arts, whether it be theater, singing, played a bunch of instruments, all that sort of through my undergrad degree, and then really got serious and thought I need to get a career going here. So got into law, discovered a lot of unhappy lawyers there. A lot of people that sort of wanted to, didn't know what to do and ended up going to law school. In retrospect, I should have gone to film school. I think that would have been more in line with what my life had been up until that point in terms of interest. But law was a fantastic education. I think that anyone that has done it, even if they don't end up being a lawyer, find it to be a very extremely illuminating education. Not something I regret, something that has helped me all my life. But from practicing in law for a number of years, I got headhunted basically by an investment bank. And the pitch was, this was the late 1990s, 1997. The pitch was they needed women. They needed professional women in particular in finance. So I made the jump finally into, after doing a sort of entry-level courses while I was still a lawyer, ended up transferring into the investment management side, on the sell side initially. So, on the product creation and sales side, and quickly figured out that was not a good fit for me either, because I had sort of come from this background of fiduciary duty, advice, not sales. And that's what I thought I was kind of getting into in the investment world. I thought it was about, it's like law, only give people advice on what's best for them and in their best interest with regard to their money. What I quickly figured out was that's not the culture that's very dominant in finance. In finance, it's very much about selling people things in exchange for their cash. And although they, talk about advice, it's really more about how to get people to take risk and give you their cash. So that was a very quick and abrupt kind of education for me, in the sense of, oh no, what have I done? And at that point, I then started doing my Chartered Financial Analyst degree, which is another 3 years of study. Because I really needed to get to be an analyst and figure out what the hell I was in this new world of finance, and the CFAs seemed to be the ones doing all the analysis. So I did that, and then realized that I needed to get out of the sales side. And at that point, that's when my partner and I started Venable Park, which is 20 years ago this fall. And it was that idea of, how do I get back to being an advisor, a fiduciary, someone who looks at people's overall picture and tries to figure out what is in their best interest and advise them accordingly for a fee, rather than trying to sell them risk or trying to talk them into, buying things from me. That was of no interest to me. So that's how we started Venable Park. And that's been 20 years later. And ironically, I didn't become the first female Prime Minister of Canada, but I did become one of the few female PMs, portfolio managers, that runs an investment counsel company in Canada. There's still not a lot of women in those roles. So that's kind of me in a nutshell. That's how I got to where I am today.
I love that. Yeah, no, thanks for sharing, your story of, how you became, the person you are today. I always find it fascinating, right, to hear about people's journey, and you definitely have a really interesting journey. And I did want to comment on to, the start, how you mentioned about having growth mindset and going through adversity, and how that really brings out the best of us, right? And it kind of also makes me think of, the idea of having like an anti-fragile mindset, right? Like being strong and embracing, volatility or, challenges, right? And coming out stronger, right? So I really appreciate that. And, so cool too, that you've been helping out, many people in terms of like the financial side. And that's kind of where I want to go to next is, I mentioned in your introduction, right? You help some of Canada's wealthiest families, with managing like their portfolios. And, so a question that I have is, how do you handle the wealth of high net worth investors? And in which areas or investments do you currently see, where smart money is being directed?
Hmm. So the reason, and sometimes people ask me, why do you only help rich people? And the truth is that I help a lot of people, not just the people that qualify to be clients of Venable Park. And I have done for over 20 years now. Is people will often send me messages through the blog that I write, which I write for free. I just write it as general information. It's 16 years old. And I've only missed 1 week in 16 years of writing on that. And I do have a lot of people that keep in touch through that and let me know what's going on with their own situation in life. And it's not that they'll be clients, it's that people need unbiased advice, big picture, that's not just focused on products. And that's what we seek to provide. That's why we're here. And so I've done that all along. And the reason that we basically keep it to a minimum of $1 million account to start is because we found that people can be hard to help. And I mean that in the sense of a lot of times, until you have amassed a sort of large portion of money, the right advice is to pay off your debt, to pay off your house, or save for a house, buy a house, get it paid for, do all that stuff before you ever need to get to an investment manager, so to speak. What we live in is a world where most people that give an investment advice or portfolio management will take anybody at all, whether they should be paying off debt first or whether they don't actually have, they should reinvest in their own education or their own business. That never even comes up in the conversation. They just jump right to, great, you got 100 grand, let's go. Or, hey, how about we borrow against your house to get some money to give me to manage for you? So this is like a disastrous approach, in my opinion. And I've seen this so many times throughout the years. So that's why we have a minimum of $1 million, because in my opinion, it's about then that people start to actually need investment management services to know, what to do beyond just savings, debt repayment, and maybe GICs, which is a great way for people to accumulate money. So what I found too over the years is the people with the most money can often be the least risk averse with it. And that's misunderstood. Again, the common theme is that if you're rich, you must take a lot of risk because you can afford it, so to speak. But that's actually not what I've discovered over the years. What I find is that people that amass wealth tend to do it in a specialty of their own. So that means in a business that they're in, or a career or a profession that they actually develop expertise in and work at diligently for a number of years. That tends to be how they actually, get their debt paid off and accumulate savings. And then when they get the savings, it's very common for people to be quite risk averse with it. Like, why would you want to risk blowing it up when it's taken you, several decades to amass? So the way of looking at that is if you invest in yourself and you develop your company or brand or your skill set such that you're able to make a good living, the next piece comes, how do you manage your cash flow? Do you control your spending so that you're not wasting? And that's very common. People get into all of a sudden making a good income and they spend their brains out and they think, well, this is what rich people do. Rich people must buy designer things or eat out constantly or all these things. Ultimately, that's a great siphoning out of savings and ultimately destroys your financial fitness over time. So it's the getting the career skill set first that starts to create cash flow and add value to the world so that you can get meaningful compensation for that. Then it's controlling your spending. And then once you get the capital, it's trying not to blow it up, which is again the opposite of most of what you're told. So the way that we do that and the way that we have done that personally and the way that has worked in building high net worth for ourselves and for others is to basically just take a portion of the money and keep it entirely liquid. So you have an emergency fund so that you're not ever caught having to sell assets at the wrong time, ideally, because you've managed enough to have cash in a short-term savings or in GIC, something that's accessible. Then you have some fixed income portion, which is things like bonds, which I often say that when people say bonds are for dummies, which you'll hear sometimes, they mean that they're trying to sell you something and they want you to not hold bonds so they can get you to put the cash into something else. That's typically why people say that, because there's that quote that compound interest is the eighth wonder of the world. Whoever said it, I am not sure, but that actually is true. But you need to have income coming off of assets and be reinvested, which most people don't get, Ben. They think that, it's not important whether something produces an income. Well, actually, if it's not producing an income, you're not reinvesting the proceeds and you're not getting that eighth wonder of the world. So there's that. Mostly what people think of in terms of growing assets today is, how do I buy something that's going to go up a lot? Whether that's, something like gold, or whether that's something like cryptocurrency, or whether that's a piece of real estate. Their idea is, how do I get rich quick? How do I flip this? How do I, and they may say that their goal is something else, like, another rationale for holding something. But in my experience, they most typically think of it as, how do I get this thing to go up? Which is a very speculative mindset. And again, I don't know that people appreciate that that's actually not the same thing as investing. It's actually like gambling. And that's fine, as long as you only do it with a fairly controlled portion of your money, right? So it's very important. And this, in my experience, is what wealthy people who have sustained their wealth over time, not boom, bust, but actually they take a good portion of their savings and mostly keep it in the lowest risk things, and then define a portion that they want to put into risk assets, and don't go above that portion. And sometimes it's as little as 20, 30, 40% maximum of their liquid savings can be in anything that's even close to equity style risk, or corporate debt, which tends to have equity style risk profile. So those things are something that can be used. But the other thing that's important to understand is that not at every price. So again, this goes back to what the sales side tells you, is that all you have to do is plop money into these things and miraculously they'll make you rich. The reality is that they're very cyclical, right? And so it depends very much what your time frame is. And I mean, you better have a time frame of 10 years or more if you're talking about any of those risk assets. Or secondly, you better have a way in which you gauge the timing around when that money is put in and when you expect to take it out. And that's what the piece that most people don't think about enough. They just think of, oh, all I do is buy this hot something that someone's tipped me off on. And you don't have a plan for scale or how much or time horizon, none of that. Just, getting in and hoping for the best. And that strategy tends to be disastrous. I mean, sometimes it works, which I've seen that, where, some people will buy something and it goes up a lot. But that's what I call a gateway drug, because very often then you either think you're a genius and you start adding more of that, which can be very dangerous if it's a cycle, right? Or you basically just, it goes down and then you add a lot more to it. Again, without a good discipline about top down, how much of your life's net worth is going into anything that risky, you tend to blow up and cause a lot of pain. And there you go back to, how do I learn from that experience? So that's a very important piece to talk about. I think in personal growth, Ben, as you know, admitting mistakes, admit, repent, reform, recover, talking about the things that went wrong is how we learn. And if we're smart or able, we can shape our choices and not repeat the same mistakes. I find in finance, not enough discussion is had about mistakes or blowups or things people did wrong. There's just this focus on, how did that person get millions of dollars, right? Without any talking about the things that they maybe should have or could have done better, or maybe, that they didn't understand at the beginning, that if they had of, it could have saved them some pain and suffering. So those are important conversations to have too. And admitting past mistakes so that you can learn from them is very important.
I love that answer. That's actually exactly why I want to ask you that question is, there's a big mentality of, get rich quick, which you had actually said. But I think the biggest thing is always investing in yourself, which you also mentioned. And so that actually makes me think, this is partly why I wanted to bring you on the show, is you're big on, timeless wisdom, and what I mean by that is, there's fundamental things, in investing, to keep ourselves less biased, less emotional, and make the right decision. So I love, first off, that you explain where you need to be both professionally as well as financially before you even consider investing. And then I love how you also went to, being in a secure place before you making that shift to getting advice. But now let's kind of say that, someone now is in that place, right? Where they've made like the shift, they're ready to make invest. You also kind of mentioned too that there's investing and speculating, which are two different things. But I think something from your book that I want to hit on that is very important, because we see this a lot, online or even on social media or even on TV. But let's kind of talk about, the herd mentalities, right? So what are examples, Danielle, of common myths or herd mentalities in the marketplace that investors should be aware of to protect their investments? And how can investors avoid temptation of chasing trends in the market and instead focus on long-term value-based investing?
Yeah, so, a really classic example right now is that we had the QE bubbles for the last decade, right? Where we had a huge increase in the price of assets in a whole bunch of categories all at once. I actually feel badly for people that are younger and who have only had the last 10 years as their experience, because I think that it's led them astray in many ways in terms of what investing is supposed to be or what fiscally prudent decision making looks like, because we've really had terrible leadership from the top down, from central banks around the world just throwing money at things, from, we had the pandemic and we had all the governments just throwing money around. And I think that it really has given people the wrong impression. Now, I relate to this because I came into the market in the late 90s, which was also the last epic tech bubble. And there was a period of time from 1997 to 1999 when things started to really go into a blow off top period. And it looked like, fantastic. Like, well, how do we get more of this? Things are going up 20% a month at this point. How exciting. In 1999 to 2000, stocks went up. The NASDAQ doubled, Ben, in 1 year. I remember it, and at that point, that was one of the things that was starting to give me great pause, because I had been doing the studying that's talked about this 6% long-term real rate of return on stocks. And here we were seeing things going up 20% a month. And you're thinking, well, how does this, if this was the norm, why would the long-term average only be 6%? What's the case? Well, it turns out that what you end up with is a big give back period, right? And so most people don't appreciate that. So it's important to do some reading about historical numbers, trends, ratios, so that you understand when you're way above that mean and when you're way below that mean, so that it gives you some indication of what the risk profile looks like. If prices are far above the average trend, the risk is much higher to your principal than if you're way below the average trend. So that gives you just some basic stuff that you can keep in mind. Another problem this cycle has been, we've had a real estate boom bust at the same time that we had these bubbles in financial markets. And so a lot of people were doing a lot of dangerous things with debt. Now, you talk about timeless truths. Here's one for you. The greater the leverage in the household, business, and economy, the greater the risk and the likelihood of loss, right? So again, during the 2021-22, Canadian real estate was going up in leaps and bounds, and a lot of people were borrowing real cheap, going out, buying cottages, secondary properties, rental properties, buying boats and throwing it on the line of credit on the house. Like all this, that was just classic bad decisions. And it would have been 100 years ago and 1,000 years ago, and it will be 100 years from now. It'll be the same human behavior with cheap credit, not appreciating the risk, thinking trends don't mean revert or go back up over time, or that the rate of interest would stay at nothing forever. Those are all classic mistakes that we make. And like I'm very sure that we will always have that risk in our DNA, so to speak, because it's so easy, right? It's so easy when rates are low to borrow money and buy things. And it looks so exciting, right? But the fact of the matter is that the longevity, the ability to be sustainable, the health piece doesn't come from junk foods and supplements. It comes from, whole foods and restricting how much you're eating and making sure that you're exercising and getting good sleep and avoiding drugs as much as possible. Those are the things that sustain health over a long period of time. And those are the types of things you have to do financially as well. So I know that that can be very not exciting to people, and especially for young people that are they're going, listen, I don't see any way to get any money going here. Like, I can't save a down payment. Houses are too expensive. I don't know how I'm going to ever be able to afford that. Never mind, have a retirement fund, never mind raise children. I get it. I have kids that are 23 and 24 years old, and I understand that there's a lot on your plate when you're young and trying to figure out all these things. But I just go back to, it doesn't matter how much money you make. At some point, you could make, $1 million a year and still go bust. And I've seen those people, because ultimately it comes back down to mindfulness, mental training, controlling your behaviors, not being too crazy and reckless, not spending too much. So ultimately, your number one job is to figure out how to find a way to make a living that's a steady income, hopefully, because sporadic income is very hard to plan your life with. But ultimately, whatever scenario, if it means moving to a different place, if it means sharing accommodation with others, if it means working from your parents' basement for a few years, whatever it is you need to do to be able to get a career started, to get cash flow positive, to get building some actual expertise and knowledge in something, a business in something, or a good job in something. Get that going, and then figure out how to save from your income. And that amount of constant saving and not taking the big, bold risks with it, at least with the majority of it, keeping it in the safer side, is how you will ultimately get a pot of money, net worth, that you can then, as I say, make a decision to, okay, I'm going to try. Because ultimately, again, most people make money building their own business. That's how they tend to get lump sums. And now if you're going to take a risk and invest in someone else's business, which is ultimately what you're doing, if you're a stock or a corporate debt investor, you're putting money in someone else's business. Well, just because it's in a public market doesn't mean it's safer than just giving random money to someone up the street. Obviously, if you don't know much about their business, you're taking a lot of risk with that capital. And I think if people keep that in mind, it's like, well, how much do you want to toss in someone else's business? Well, you'd be like, well, I don't know. Let's look at how they manage things. What's their balance sheet look like? What's their income statement look like? What do I think of their values? What do I think of their prescience, where they're heading with that business? Those things are pretty hard to gauge. And so that should give you pause to know that you don't want to take a lot of blind risk with your hard-earned savings.
Absolutely. Yeah, no, I think those are some great points. And, it's definitely really important, I think, that people are always due diligent before doing anything, right? Because again, just like you said, I love that way that you kind of explained, putting your money somewhere else into someone else's business, right? If you don't know what you're doing, it's like giving it to someone on the street. So I love that concept. And, something that I want to explore here, assuming that, people have, taken enough time, to take personal responsibility, invest in themselves, they have a career going, and they are now trying to think smarter, in terms of making investment decisions. I know you're a great person, to explore this with, because you do a good job at, being less biased and following emotions, and you have your principles, strategies, and tools. So if we explore some investing, mental models, or frameworks that can help investors make better decisions, what do you believe are the key factors that investors need to understand about the complex world of finance in order to assess potential investments effectively?
Okay, so you should understand that it's designed to take advantage of your monkey brain. That's the first thing. And we all have a monkey brain. Okay, so everything that's inundating us every day, from financial quotes to talking heads to whatever product or risk that seems to be attractive, that is all working on our subconscious to make us think that we should be doing something other than we should be doing. That is the case when markets are going up, and it's the case when markets are going down. So if you don't have your own rule set around your exposure or how much you're going to risk in different areas, you're going to be always at the whim of whoever you're hearing from next. So my first thought would be, for example, there's a lot of study to show that stock picking in itself is an extremely difficult thing to do. I mean, statistically, 80% of new startup businesses go bankrupt within the first 10 years. So that's the first thing to keep in mind. And good prospects or companies can be bad investments. It doesn't mean they'll necessarily make their shareholders money, but they could still be a successful company or be bought by someone else, et cetera, down the road. So again, back to, what kind of risk exposure do you want to have there? I would suggest that you should never put more than 5% maximum of your savings in any one company. So if you look to even ETFs or the indexes, which is usually a great way for people to get exposure. So instead, because stock picking is such a challenging thing, and if you pick 10, 8 of them will probably go bust and not make you any money at all, and maybe one of them will make a return. So you can see the math there. It starts to become quite problematic and how to get ahead. So you can do things like ETFs or indexes, or there's a whole bunch of mutual funds that mimic those indexes, of course, and charge a fee to do that. But the other thing you have to appreciate is within the index, it matters what the concentrations are. So for example, today, the S&P 500 is 14% made up of the Apple and Microsoft. Those two together are 14% of the S&P. And year to date, everybody's been moving money into these two, star turns. So what that really tells you is that, back to my rule, you shouldn't have more than 5% maximum in any one company. If you look at what people think of as a broad-based index, it turns out you have a lot more concentration risk there than you may appreciate. And that most of the companies in the index are actually having a very tough time right now because we're late in this economic cycle. We're heading probably into a recession where profits tend to take a big dip. So I think that the best thing you could be doing right now is, if you've actually built up savings where you're thinking of wanting to take some risk on the equity side, again, define the percentage that you're prepared to do that. Do your work in terms of what you want to put that money into, so that 20% or whatever portion of your assets you think you want to put into equity based, again, with a time frame of longer than 10 years. You can look at what to buy, but be mindful of the fact that in recessions, you typically see a drop in S&P earnings, and broad market conditions tend to get very negative. And it's quite common to see stocks fall from 25 to 50%. So what that should tell you is, this is a great time to be building your cash, doing your work, and figuring out what your percentage is that you want to put in things like the S&P or the NASDAQ or the TSX, or which sector you may want to put money into. This is a great time to be doing that work. It's not really a great time to be putting the capital actually in or holding the capital in. So right now, a lot of people are saying, well, we think that the bottom was last October, and we think we're going to see prices rise from here on in. And they definitely have bounced in the last few months, for sure, year to date. But the valuation issue has not been repaired. In fact, it's even worse. And if we haven't had a recession now, we haven't had a real recession since 2008-9. We had the initial downturn in the pandemic, but of course it was bailed out by all this free money flowing everywhere. Well, we've got the opposite today, Ben. We've had, the money supply contracting. We've got the leading economic indicators have been negative for 13 months. What this should do is you shouldn't think of this as, oh, this is a doom and gloom message. This is actually the most exciting setup we've had in at least 15 years for buying opportunities. And I mean that in most asset classes. So you can see that things like government bonds tend to go up during recessions. They tend to appreciate in price. So that's one of the areas where you can actually be when things are when the risk side is falling. But also just to think, oh, great, we may be able to get it back into things like the S&P and the TSX index with the portion of the money we want to have in growth assets at prices that are 25, 30, 40% cheaper than they are today. And what that means is that the dividend yield that will come when prices are that much lower is going to be probably 3 times higher than you can presently get. So back to how our actual returns compounded over time. What's the 8th wonder of the world? It is this reinvestment of dividends over time. So it's everything about how do we get the highest income yields, and how do we not withdraw them as much as possible, not pay them out in high fees to different types of money managers, but actually keep the fees as low as possible, reinvest the income as it comes in, and not touch it or withdraw from it, ideally for, as I say, 10 years or more. So all those things are kind of when you get the best optimal situation for adding equities to your portfolio or risk assets. And when it comes to real estate, we're also at a very exciting inflection point here. So for all the people in their 20s and 30s who think it's hopeless, that they're never going to get a shot, I think they're going to get a shot. And I think it's going to come in the next couple of 3 years. Typically, it takes 4 to 6 years for a real estate cycle to bottom. This one peaked in 2022. We're starting to see some serious downturn in all sorts of indicators that suggest we could have prices falling for the next 2 or 3 years. And at that point, the opportunity for people that have built up their savings and know where they'd like to buy in what area and all that may have an excellent opportunity to do so again. So there's a definite upside. There's a real generational opportunity in these cycles. But you have to have that mindset. You have to be top down. You have to appreciate the historical precedence of things. You have to understand that it's not about how do I flip and get rich quick. It's how do I build this cash flows reinvested over time that I don't spend too much of, that build this buffer that ultimately is what everyone's, this wealth that people are seeking on the financial side, but also on the personal side, Ben, as you know, on the life longevity side. How do you stay the course? How do you get to be 60 and not be, physically decrepit and, miserable and angry and closed? How do you avoid that? I would suggest you avoid that by constantly trying to have personal discipline, do healthy things, do things today that will pay off tomorrow, figuratively, of course. And keeping open, learning, admitting mistakes, all that stuff is really what makes people successful, in my opinion, over time.
Absolutely. No, I couldn't agree more with you. Having sustainable habits, having a strong mindset. Talking about mindset, I want to pinpoint, you talked about cycles, you talked about, millennials or anyone that's tuning in right now, to have that idea of, hey, you don't need to be emotional here. You don't need to rush any decisions. In fact, with investing, you should never rush any decision. That's how you get hurt. But something that I want to touch on is, with cycles, they do play a role, right? Because we're always doing our best as an investor, to try and buy low rather than buy high, right? And so a question I have for you is, what role do market cycles play in investment decision-making, and how can investors utilize the understanding of this to their advantage?
Yeah. So, on my blog, I have a recommended reading list. And I would suggest there's a ton of books that helped me a lot in my awareness of all this stuff. But it would behoove people to go and read some of the older books that really I swear you'll be reading them and go, oh, this sounds like right now, or this sounds like 2 years ago, or oh wow, yeah, this could be, it's so classic that you will have those aha moments. So that's why it's useful. There's nothing irrelevant about financial or market history because it's very cyclical and continues. So that's an important thing to appreciate. The other thing is equity cycles tend to be 5 to 7 years of expansion and then a couple of years of correction. And I suggest to you that we're in that couple of years of correction period. And so again, you can't be thinking you can jump in every day. You're never going to get the bottom with everything. But if an example, for example, here's one that struck me. So Nvidia is a very hot stock right now. Everyone's been talking about Nvidia, and again, like Apple and Microsoft, it's been driving a lot of the gains in the overall benchmarks because it's become quite weighty in the overall benchmarks. But the thing is that Nvidia did this in 2000 as well, when it became a big hot tech stock, and then it quickly crashed 92% over the preceding 3 years and took 15 years to recover the prior value. That's the kind of cyclical stuff I'm talking about here. That's what I expect is going to happen again, because something like Nvidia is trading at 29 times sales. If you don't know that 29 times sales is absolutely lunatic fringe, then you haven't done enough work yet, because basically 2 times sales is considered a kind of a reasonable, good metric. 10 is crazy. 29 is ludicrous. So if you're buying it, I hope you're doing it with some kind of, again, very small portion of your principal, and you're day trading or something as a way of trying to make money at it. But I'd suggest to you that the statistics would show you'd be better off going out and picking up some other new skill that is tangible and actually active, rather than just trying to day trade something, because the statistics are that you'll maybe have some success and then you're going to blow up and you're going to be none the wiser for it. So again, it goes back to understanding how long these cycles are, what reasonable valuations look like for multiples, whether it's real estate. It's not widely understood, Ben, that 3 to 4 times your household income was always a long-term considered a good affordable ratio for house prices to income. Well, most people got into buying houses that were 8, 9, 10, 11, 12 times their household income in this period that I've described, this decade where rates were so low and everyone forgot the rules. And so if you're, most places in North America today, it makes much more sense to rent than it does to buy. But you're classically not often being told that. You're mostly being told you've got to get in on the property ladder, you're missing out if you're not getting in. That is not true. It depends on price. So yes, if we get a significant 2 or 3 more years of downturn in the housing market, and we find that properties are coming up that you can pay that are maybe 3 or 4 times your household income, you can buy them on an amortization of 25 years with a down payment and still afford them. That's when housing becomes a very attractive option, but not just at any price. And I think that's the thing that people have to understand, what reasonable valuations are depending on the asset class that they're looking at, and then understand whether that means it's a good or a bad time to be adding capital there. And that's just work. Like, there's no kind of quick, easy, what's the rule, what's the trick. I know what I'm describing maybe doesn't sound very sexy, but it works. It works, and it will give you, peace of mind, stability, the ability to sleep at night. So you're not running around deranged and, doing very self-destructive things. So it's this keeping the monkey brain in check, keeping your discipline, keeping your wits about you, understanding that people do crazy things, and that means you have to be aware enough to recognize that they're doing those crazy things and not do them with them.
Makes a lot of sense, Danielle. And I actually have a question in terms of, you talked about, taking like the time, to learn, right? And so a question I have for you, it seems like this is not an instant, listen to this podcast right now here and know what to do, right? But a question I have for you, someone who has a lot of experience, has been very successful, has read a lot of books, has talked to a lot of other high-level individuals financially. What are some of the most influential financial books that you've ever read that you suggest, a millennial who's tuning in right now checks out?
Sure. Well, we could put a link to the list that I've put on my blog, but I think that The Crash of 29 by John Kenneth Galbraith is excellent. It's short. He wrote it 25 years after the great crash. It was in his memory, and the behaviors in there are classic. You're going to recognize them today. His book, A Short History of Financial Crisis, is also a very worthwhile book. Again, thin, small. You're going to have aha moments all through that. There's, When Genius Failed by Roger Lowenstein, which is the whole long-term capital fiasco that again happened early in my career in 1998, when, there was a lot of technology and trading and geniuses with algorithms figuring out this system that looked like it worked so well for 2 or 3 years, and then of course blew up the entire financial system. So again, there's these themes, there's these characters, there's these behaviors. And whenever they throw a leverage on some of these themes and characters, disaster inevitably follows. It's a question of how long. So again, just that kind of awareness and wisdom and context just is so valuable. And understanding that, just because something is really undervalued doesn't mean that it'll go up really quickly. And just because something is really overvalued doesn't mean it'll come down really quickly. But over time, those are your kind of compasses, your rule set. Again, if you're not aware of those rules and you're not doing something based on a fundamental or, having done analysis and figured out what you think the thing's worth, then what are you doing? Right? If you haven't done any homework to figure out, I think that the price should be this, and it's 10 times less than that. Oh, great. Or, it's 10 times more than that. Oh, so what's your plan? And I feel like people maybe could do this more with a coat that they wanted to buy, right? They go, oh, I'd like this coat. I'd pay X, but I wouldn't pay 10 times X, right? Because it's just a coat after all. Right. And this is the way they need to think about financial decisions too. A house is a house. It's actually consumption spending. It's shelter. It's very valuable, but traditionally it has not been an investment. That has been something that has really come to fore in the QE era of ultra low rates when things were leaping much faster than historically normal. And what we should expect is a period now of the opposite conditions for a significant period of years. And so that will recover, bring back value and opportunity, but it'll be hard on the people that went into it highly levered, right? It'll be actually catastrophic in some cases. But that's why we have the bankruptcy laws in this country. And why? So that people can make mistakes, write off bad debts, and then restart, hopefully with greater wisdom and appreciation for why debt is dangerous.
That makes a lot of sense. Well, I appreciate you, sharing all those different books and all that wisdom there. Something that I want to go a little deeper on here, you talked about asset classes. In your opinion right now, which asset classes are most attractive? Like, for example, is it gold? And, which ones right now are most undervalued, for people to maybe do a little bit of due diligence or learning on?
Okay. So, with gold, I always say gold bullion. Some people feel that there is going to be, it is an excellent insurance policy for if the banking system was to collapse, that they would have gold bullion. And I've never argued against, again, whatever gives you peace of mind and a sense of utility, great. And so that would mean that for some people holding gold in their safe, I would suggest in their house or in some safe storage place. But as far as the gold shares go, gold miners, you'll notice they're off significantly in the last little bit. Gold has rolled over again. These things have been the benefactors of some of this QE crazy as well. So I would suggest to you that we should see a price shakeout in all those things that traded up on the easy money era, and they may actually lose value for the next while. So as long as you're appreciating that, you don't want to fall in love with a thesis that goes like this, gold will only go up. That will probably set you up for great mental torture because that's highly unlikely. I mean, gold today is back where it was, at the cycle peak in 2011, basically. So and then people say, oh, but, in Canadian dollar terms, it's done great. Well, okay, actually, if you look at how much of that gain was in the US dollar, it was most of what happened in gold. Very little of the gain actually came because of the actual metal. It was mostly to do with the currency. And so you have to keep, anyway, so not to upset gold bugs. I've said, if you like to have some bullion, please have it. But keep in mind what percentage of your net worth you want to have in that, because it's your bet that everything else is going to go to hell, right? So if you've got all your net worth on that bet, you might want to rethink that. Okay, because what if it doesn't all go to hell in terms of what if the world doesn't end? What if the banking system doesn't collapse? And the odds are that it won't, that it'll go through a very difficult time, a writing down phase, a bankruptcy phase, insolvency, all that stuff. But ultimately, we'll come out the other side of that. That is the highly probable outcome of this whole scenario. In terms of cash, we've never been paid more on cash since 2007. So what an awesome place. This is what we had in the 2007 meltdown. We went into that with a high cash weight in our portfolios, and it was making the same rates as it is today, more than 4%. How great is that? Talk about compounding interest as you go through this, where, the other assets are dropping. That's what you call dry powder. That's fantastic. And as I said, government bonds tend to appreciate in value during this environment as well. But the everything else, the equities, the cryptos, all that stuff, if it went up on the easy money era, you should expect that, in the credit contraction era, that it struggles or goes down significantly. That would be the actual normal scenario.
I appreciate that answer. And it makes me think, after hearing it, how are you positioned? Like you brought up cash, how it's very key right now to be, how are you positioned, or what's kind of like your mindset strategy, to approaching, like the next couple of years?
Yeah, so we have about 40% of our portfolio in T-bills and money market things that's earning, the cash rates right now, which is great. And we have about 60% of our portfolio in the highest quality credits. So again, not all long, in the 1 to 5 year terms, as well as out to 8 years term. So that's where the bulk of our capital is presently. And when we see this cycle continue to play out, our expectation is we will be adding corporate debt. Just to give you, again, a sense, if you don't know that high yield spreads, so the differential between the junkiest high yield, it's called high yield, which is an oxymoron in the last few years because high yield was actually yielding what government bonds used to yield. But now we have a spread, say a 5-year corporate high yield bond is yielding about 4% more than a government bond of that duration. So if you don't know that it's normal in recessions for that spread to go to 8%, then you haven't done enough homework. So if you're going to look at adding high yield debt, which pays higher interest rates, that's great. But understand, again, timing is really important. And you want to do that typically around when equities have sold off significantly, because corporate debt falls with equities. And that's when you're going to get, buying bonds for 60 cents on the dollar, that then the yield is going to be 10, 12%. So thinking about risk is lower because prices come off significantly, and the yield you're going to be compounding, reinvesting, is that much higher, like twice as high as you can get today. So that's another really exciting way. You don't even need equity risk if you can wait and buy corporate debt. Those same companies, there's less solvency risk in the debt than there is in the equities, because if a company has trouble, it's quite typical for the equity to get wiped out, but for the corporate debt side to be restructured or to come back over time. So you have more risk on the equity side than you do on the debt. And yet, if you buy corporate debt well, you can get yields way above what people think of as normal in equities. So again, there's a level of understanding, awareness, sophistication, homework that has to go into that. Otherwise, you're the greater fool. Like if you don't know why you bought something, or what the historical norm is, or what your upside target is, or where your sell rule is, if you don't know any of that, you don't have any business doing any of this. You need to go do some work, front load your knowledge and discipline, right? And then you're going to have a much better chance of making money, but also keeping it over time.
I love that. And that actually leads, to my next question. If investors try and improve their competence, right? Because to make better decisions, we need to be more knowledgeable. We need to do our due diligence, which we talked a lot about that already today. So a question that I really want to ask you is, how do you define and expand your circle of competence? And what strategies do you use to stay within it?
Mm-hmm. Well, fundamentally, if we're talking about the baseline, okay, what I do is a lot of mental work. So a lot of meditation. I get at least 8 hours of sleep a day. I avoid drugs. I try and exercise. I have a whole foods, plant-based diet. I basically do everything I can to keep myself feeling positive, stable, and grounded. So those are very important aspects. I'm fortunate enough to have a great family, not my immediate family, my kids and my partner. And that's a great a great area of support as well. But, those things are critical in my view to keeping yourself stable, grounded, and positive in your outlook. And then the other thing I do is constant work. I mean, probably 12 hours a day of, getting up really early and doing all my reading, all of our checks, all of our, fundamental and technical filters that we follow. We do a month-end letter to clients, which forces us to consolidate our overall analysis and assessment of the conditions and what we're waiting for, what we're looking for, price levels, all of that. So that constant work. And again, I find that part is what a lot of people fail at. They're good at getting into something and they're not very good at doing work around that, or maintaining the discipline of checking their thesis, or checking their rules, checking the valuations, the measurements. So again, if you're not going to do that work, you'd be better off to not do it at all and just stay in GICs or high interest savings accounts, something where you're guaranteed to have this compounding interest without taking all the capital risk. So it's those fundamental things. It's keeping up the workload, which is significant. You have to keep current. And then, again, the rules about how much of your principal can be ever risked in this or that, or what ratios, percentages, that kind of thing. And just sticking with that. You should have, dynamic asset allocation sheets to know that you're at your maximum in your exposure to that particular thesis or, company or asset type. And if you're starting to go over, you need to pare it back. Just that basic skill of reweighting is something that can make a huge difference over time. And yet people tend to fall in love with things that have gone up and want to add more there instead of paring back and reallocating. So, again, not rocket science, but really how do you stay in for more than 25 years? I'm now 58 years old this summer. I've been doing this a long time. How do you do it without blowing up? You do it with all these things that I'm talking about.
I love that, Danielle. Well, I really appreciate that. And, this ties in, to my show, right? Of personal growth, of making better decisions, of improving our health and wellness. And so, a question that I want to ask you, that I ask all my guests on my show is, the purpose of this podcast is to inspire millions of people across the world, to achieve greatness and improve their overall well-being. But what is your definition of greatness?
So for me, it was always, I want to be of value. I want to be of value to the people around me. And that's really been my constant theme since the day I was, that I can think of when I was a kid. I want to be of value. I want to be of help. And that's still my mantra now. And I think that as long as I'm doing that, I feel like that's greatness in perhaps its own small g way. I think everyone has their own concept of greatness. And it's ultimately up to each of us to figure it out. And I think we have to be careful. Like when my dad said he wanted me to be a lawyer and he wanted me to be the first Prime Minister of Canada, female Prime Minister of Canada, I think you have to have the courage to, okay, I'll try, expectations from others can direct our behavior. I'll try it. But then if you get there and you feel like your heart's not in it, as long as you've done the work and you're not being lazy, right? You're like, oh, no, I've done the work, or I'm prepared to do the work, but this isn't actually the path I want to be on, or this is not where I feel fulfilled or in line with my value set. You have to have the courage to say, okay, I got to make a change here, or sorry, so-and-so, I can't fulfill your dream. I have to figure out my own. And I think that's, not being afraid to pivot, not being afraid to change, not being afraid to go back to school. Constantly learning. I finally went back to film school last summer, by the way. It's taken me a long time. But I think that, part-time, we can do these things now in the world of the internet. So I think it's never too late to make another, to follow another dream, another thought pattern, to add to your bucket, to be of value, to be of use, and, just keep trying, fight the good fight. That's all I got.
I love that. I love that. Really inspiring, beautiful definition. And, are there any quotes that you want to share with my listeners that you live by? It could be, on life, or it could be on investing, that you want to just add to this conversation on one of the final notes?
There's so many, and I write a lot of them in my blog, even on a daily, weekly basis. So if people want to have a look at jugglingdynamite.com, I put clips, I put articles, I put links to other people's wisdom. I think I've been told it's a great resource for people. But I think, continually learn, do the work, make sure you figure out what you're about. My high school teacher said to me in grade 10, stand for something or you'll fall for anything. And I think when it comes to life, when it comes to money management, it's all so true. That thing, that one thought has stayed with me so often, in the madness of crowds and everybody doing things all around you. What do you stand for? What is your rule set? What is your goals? What's your North Star? And if you can define that and stick with that, I think that you end up with a life that's mostly maybe not, not what's that saying, not what you want, but what you need. I think you'll surprise yourself with where you may end up and how fulfilling it can be.
Oh, wait, no, 100%. I appreciate those final words there. And, I want to take this last little bit of time, to really thank you for being here. Thank you for your energy, your time, your wisdom. I know my audience for sure has really enjoyed tuning in and is also probably grateful as well. So thanks again for being here. But before we go, where could they go if they have more questions? I know you already mentioned your blog, but are there any other spots that you recommend they go?
I think that's the best place. Venablepark.com is our money management company, but most people, as I say, it's a boutique. It's meant to be for a niche sort of person. Most people will contact me through the blog. And again, if they have some basic questions or looking for a bit of guidance, I'm never, I've always done my best to be of value there and help to people.
All right. Well, I appreciate that answer. And for those tuning in, you know where to go. And Danielle, again, thanks for everything.
Thank you, Ben. Good luck to you.